Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about how much risk should I take with my investments in retirement. Tyler and I hear this a lot. People will come in and they want to know, okay, now that I'm looking to retire, how safe should I make my portfolio? And I use the word safe because, again, you've heard us say this in the past. Conservative doesn't necessarily mean safe. And safe, when you're talking safe, you're talking cash, okay? You're talking CDs or something like that. But we see it a lot where people will come in, we meet with them, and they think that because they're going to go through the process of retirement, that everything changes so dramatically that they try to lock down and have positions that are significantly more conservative than they had while they were working. Well, to a certain degree, that is right. But also, you have to remember, we hope you live a significant number of years past retirement. So everything doesn't stop at your retirement date. You still have to get gains in your portfolio to keep up with certain things that we're going to talk about here when it comes to risk. So the first thing we're going to do is look at, there's a number of different types of risk. So when people ask, is my portfolio too risky? We need to find out, really what are they referring to when it comes to risk? The number one risk that I think most investors and retirees are concerned with is market risk. And what market risk is when the market has significant volatility across the board and it goes down. For instance, in 2018, in November and December, we had significant market risk and the market went down pretty substantially. The thing is, there's an old saying that, low tide drops all ships. Well, that's what market risk does. You cannot diversify out of market risk. Okay, so understand when the whole market goes down, if you are in the market, you are going to go down too. Just the question is, how deep are you going to go? So let's look first at some of the risk that's out there, because many times people think that they're not taking risk at all, only to find out that they have significant risk, but it might show up in the forms of inflation or something like that. So Tyler, outside of market risk, which you cannot diversify out of, understand that when the market goes down, due to the market going down, market risk is going to take everything down. That's why many times we will build up cash positions. We will sell off certain positions in the portfolio, move it into cash if there's significant market risk, so we can protect that cash and then buy back in when the market starts to show some stability on the bottom. But what other risk do we have there, Tyler?
Yeah, and indeed, before I get into the other types of risk, just one more thing with market risk. Market risk is something that, as you said, you can't diversify diversify out of it. Reason being is that it's going to affect anything and everything no matter what. So an example would be an overall recession, political turmoil, interest rate changes, natural disasters, or even terrorist attacks. Different things like that, no matter how good your investments are, no matter how good you think the company stocks are that you own, it doesn't matter. Something like that usually drags down the overall market in general. So that is the number one risk, being market risk. But then in addition to market risk, there's also something called, another big one is currency risk. And currency risk is the risk that the price of one currency can change in relation to another. And this is one that we see oftentimes with investors or people who are working within an employer-sponsored plan and within their 401k, and if they have any type of foreign or international stock funds, these are the ones that typically get hit by the currency risk. And investors, again, who have those international stocks or emerging markets, they're exposed to that risk that may create unpredictable gains and or losses. And I see it oftentimes where we have many people who come in and they might have a 401k through work or an account set up through a different firm, and they consider themselves relatively conservative or even moderate. and yet they carry half of their investments are in international stocks, and really international is the most volatile asset class there is. So it's important to learn, okay, you might not think that you're that aggressive with your portfolio, but yet if you have international positions in there, that automatically will make it more aggressive. So currency risk, a big one, especially if you hold any type of international or emerging market positions within your account, that's one to pay attention to. Another one would be inflation risk. And inflation risk is the risk that inflation will undermine the performance of an investment. And if the inflation rate is rising more rapidly than your investment's potential earnings, then inflation could erode your investments over time. And oftentimes when we talk about inflation risk, we see that in different types of fixed investments, things like bonds, cash, money market funds, CDs, and fixed annuities. Those are what's most at risk when we talk about inflationary risk. And the reason being is that with investments like those, typically they're going to be more conservative. You're not going to have as much growth potential in those investments. So with not having the growth also comes a level of protection and stability, but at the same time, you run the risk of inflation outpacing the returns there.
Okay, good points, Tyler. As far as inflation risk, this one is the one that Tyler and I tend to see an awful lot of when we have people come in and say, well, my retirement is scheduled, let's look at the portfolio. Here's what I would like to do. And, they want to take some portfolios that they had in their 401ks, roll them over and maybe look at nothing more than CDs or fixed retirement income plans. It sounds good from a safety standpoint, but as Tyler said, from an inflation standpoint, you hold on to those retirement plans for 5, 6, 7 years, and all of a sudden you realize that you don't get enough of a withdrawal from them to help offset some of your expenses that may have increased due to inflation. So that's one that we see quite often. Tyler, what else as far as like interest rate?
Yeah, another big one is interest rate risk. And that's the chance that investments will suffer as a result of interest rate changes. Now, when we talk about interest rate changes, they're going to affect bonds the most due to their inverse relationship with interest rates. So what that means is if interest rates go up, bond prices go down, and vice versa. So interest rates really affect bonds. So whenever there's an interest rate change, bonds are affected the most. But then in addition to bonds, interest rate changes also indirectly affect stocks as well. And we saw that toward the end of last year in 2018. What happened was the market took a big dive in December, and part of the reason was because there was talk about the Federal Reserve, who controls the interest rates. There was talk about them aggressively raising interest rates, and stocks don't like that because what happens is right now interest rates are very low, and companies were borrowing. There's big Fortune 500 companies that they borrow millions of dollars every single day at a really low interest rate, then turn that money around and they can grow it at a much higher rate than what they borrow at. So companies really like when interest rates are low. And last year toward the end, talks about aggressively raising rates. Well, the market doesn't like that because if you go and aggressively raise rates, then companies won't borrow as much because the rates aren't low anymore, and that could lead to a potential growth slowdown. So interest rate risk is another big one. Whenever there's talk about interest rate changes one way or another, it has some effect on the overall market, both stocks and bonds combined. So those are the main ones when we talk about different types of risk: market risk, currency risk, inflation, and interest rate risk. So that's kind of a good way to set this up here with the different types of risk, and then pretty soon we're going to get into the different pitfalls by being too aggressive and too conservative.
And that's what we'll look at now. We'll look at the pitfall of being too conservative. As I said just earlier, it's a situation we see quite often. People are looking towards retirement. They say, well, I need to get more conservative. I need to have more safety in my portfolio. Yes, that's a good direction to go, but how far do you take it? So again, when we see people with a portfolio that is significantly too conservative, not based on the risk, but based on what they feel they should be doing, you need to look at it and say, okay, hopefully you're going to live, another 20 or 30 years in your retirement. That is our goal, is to have a long life where you can utilize your retirement plans. However, if you get too conservative across the board in all buckets of your retirement income, chances are you are going to use that money too quickly, or again, inflation is going to come in. And what's going to happen today, your withdrawal might be fine and it's serving its purpose, you're paying off your bills, but in 5, 6, 7 years, it's going to seem like it's not paying off the bills. The reason being is those expenses and bills are going up due to inflation. So the thing with being too conservative, yes, it will help mitigate. It'll help soften that downside when the market has significant volatility. So again, if we look at last year, 2018, and November and December, when the market went down, there were a lot of investors out there, whether they self-managed or they had an investment advisor working with them, whereas the market started going down, they started selling positions and getting into more conservative positions, which helped soften the blow of market risk. Again, you can't diversify out of it completely, but you can start to soften the blow. But then when the market started to pick up again in January of 2019, and it's been on a tear ever since, a lot of these portfolios were so conservative on the downside of the previous year that they didn't have the ability to pick up gains. So again, you need to stay contemporary and current with, geopolitical issues and what's going on. So when you get into retirement, we're not necessarily real advocates across the board with just a buy and hold strategy. We think you need to look at issues. We think you need to look at the possibility of going after certain sectors that are doing well, not just lock it down into a conservative portfolio.
Yeah, good points there, Dean. When it comes to pitfalls by being too conservative, this is one of the biggest mistakes that we see people do is to be too conservative with their retirement funds and their retirement investments. And oftentimes people have the preconceived notion that they need to be all conservative, all in bonds and CDs, different types of fixed conservative investments when they hit retirement. But then again, if you do that, you run into inflationary risk, which is what we just talked about. And as you mentioned, Dean, by being conservative, you can help mitigate downside when the overall stock market goes down, but you won't rebound as well when it goes up. In addition to that, people who are too conservative with their retirement funds, they're usually, like I said, going to have a majority in fixed investments, bonds, CDs, fixed annuities, and all those things are all driven by interest rates. And low interest rates can hinder growth and make it tough to replace withdrawals in retirement. And that's what we're seeing right now, where interest rates are so low that whether you have, a savings account, short-term CDs, bond positions, different things like that, you're not getting the growth out of those due to the low interest rates. And it's going to be tough to replace your withdrawals over time in retirement if you have things that are all very, very conservative. And for example, if you have $300,000 in retirement funds and you withdraw 6% of the account value per year, so 6% of $300,000 would equal about $18,000 annually, and you can use that out of your retirement accounts to supplement your Social Security benefits and or pension. That would be a good chunk to use to supplement your income. And if you were in only very conservative investments, like I said before, CDs, fixed annuities, short-term bonds, they might average, anywhere from a 1 to 3% rate of return per year, then you're never going to be able to replenish your withdrawals over time, and eventually you'll run out of money if you live long enough, because if you're withdrawing 6% of the account value, but your investments are only growing at 2 or 3% over the long term, eventually you're going to draw that down, and it could be relatively quickly if you ever increase your withdrawal amount as well. So another thing is, by being too sure, you want to slowly shift conservatively as you get older and as you get closer to retirement. But if you become too conservative, then you also run the risk of drawing down your assets too much, and you can't replace that over time. You can't replace those withdrawals. And Dean, I know that you touched on this, but it's important to note that many people believe that conservative means safe, which it doesn't, because bonds are one of the main examples here where bonds you can lose money in, and people always think bonds are safe. You can't, but you can lose money in bonds. Obviously, they're not going to fluctuate as much as stocks, but bonds, you can still lose money in those. But when it comes to being too conservative, just keep in mind that, sure, as you get older, you do want to become more conservative, but there is something as being too conservative. You still want to have at least a portion, and we're going to get into this a little bit later, but you want to have at least a portion of your retirement funds that are utilized for some growth potential.
Okay, good points, Tyler. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about the pitfall by being too aggressive. So again, we talked about being too conservative. We also see where investors, when they retire, they become too aggressive. And the triggering device here is usually they feel they don't have enough money to properly retire. And what I mean by that is they're going into retirement because they either don't like their job, they lost their job, whatever it may be, but really financially it probably isn't their sweet spot yet. It probably doesn't look good or 100% of replacing what they had when they were working as far as salary. So what happens is we'll see investors make a decision to become significantly more aggressive in the market, especially when there's a nice run of a number of months where the market is going up. And they'll become too aggressive, hoping that they can make significantly more money than they may have made proportionately while they were working as their last hurrah going into retirement. This is very dangerous. We've actually heard of people in the past going into retirement when the market is going real well. They've actually borrowed money or looked at mortgaging their house to go in and buy investments because the market's doing well. That is very dangerous. We do not advocate that at all. So really, you need to go into retirement, and if you honestly feel that you're not going to have enough money, so you need to take significantly more risk to get significantly more gains, chances are you should probably continue to work then. Okay, I mean, it's just as simple as that. So you don't want to become too aggressive. You have to look at a number of things too. Do you need to become more aggressive if you properly allocate your monies and have a financial plan? This is one of the reasons that we tell people sit down with your advisor, put together a financial plan so you can see what your withdrawal percentage is going to be. You might be surprised. You might find out that your investments are actually going to generate the withdrawals you need without going beyond your risk tolerance. So let's not become too aggressive either. There's a happy medium. Tyler, what else as far as being too aggressive?
Yeah, so obviously on the other end of the spectrum from being too conservative, there's also being too aggressive. And being too aggressive, it can hinder your retirement portfolio for different reasons. Now, being too aggressive with your investments, that can force you to go back into the workforce after retiring because principal is lost due to stock market downturn. And that's what we've seen back in 2008 was one of the main times that we saw that happen, where people weren't allocated correctly within their 401ks, their IRAs, 403bs, whatever it might be, but they had a lot of money in retirement funds, and if they were 100% in the market, meaning they had large cap, small cap, mid cap, international stocks, if you were all allocated to stocks at that time, then you lost exactly what the market lost and maybe even more if you had more in different types of aggressive stocks such as small cap, mid cap, and or international. So that's what we saw back in 2008, where people just simply weren't allocated correctly, meaning they were too aggressive. And many people really didn't even realize it. They thought their investments were structured and set up properly, not expecting to see the downturn that we did back in 2008. And because their investments weren't allocated properly, that's what happened, where they went down. They had a big market downturn at that time, and they were forced to go back into the workforce and work again, which is something that you never want to do after you retire. And this mistake, being too aggressive, is more common among those who haven't saved enough early on, so they have to play catch up, as we call it, later on in life, and they feel that being very aggressive can help. Now, it can help during times of market gains, but it can also be very detrimental during market declines. And what I mean by that is, usually we'll see people who, early on in their life, maybe they were more so focused on, maybe they wanted to pay off their mortgage first, or they incurred large amounts of debt, whether it be student loan debt, credit card debt, and they wanted to get that taken care of first, or they simply just neglected saving for retirement and delayed it down the line, and they were more so as a spender as opposed to a saver early on. Well, then later, all of a sudden, they feel like the pressure's on, so they try and save as much as they can, but at the same time, they also think that by being very aggressive, that can help me just as much, if not even more, than saving. Which, again, like I said, if the market's doing well, it can help. But when the market has a decline, if you're older, if you're playing catch up and you're allocated very aggressively in, for example, all large cap, mid cap, small cap, and international stocks, and there's a big decline, then you're really going to feel it, and it's a dangerous game to play if you go about it that route. So to counter that one is we harp on it all the time, but that's to start saving early and often and not push it back and not have to play catch up. But if you do have to play catch up at that time, the most important thing is not about the rates of return and not about being very aggressive. It's about how much you save and how much you put away. So again, that's a mistake. If you have to play catch up later on, don't be super aggressive. You want to make sure that you still have a balanced portfolio to your risk tolerance and that you're saving a good chunk of money.
Okay, Tyler, I just thought of something too when you're talking about this. And when it comes to having to become risky or more aggressive because you feel you need more money in retirement, that's typically also a sign that you did not control your debt going into retirement, why you feel you need more money to pay your expenses. So again, that's another reason that you've heard Tyler and I talk about this, and that is during your 50s, you need to be as aggressive as possible in paying off your debt. So you go into retirement, you don't have to take undue risk in your investments to try to get gains that are above your risk tolerance.
Exactly. Good point there, Dean. And as you mentioned, ideally during that time, you want to have all your debt taken care of. Now, it's not realistic for everyone, but by taking care of debt, that can allow you to save more early on and not have to worry about being too aggressive to try and pick up gains later on in life. Another thing, people also, they mention it from time to time. This one isn't as big, but people, sometimes they might speculate with investments or try short-term trading, which is risky, and that typically always leads to trouble. So that's something that you want to stay away from as well. We're going to get into this a little bit more here as we close out the show in a few minutes, but one happy medium between being too conservative and too aggressive is what's called an actively risk-managed portfolio. And I know that we touch on this one a lot, but it kind of takes the best of both worlds, and that means you attempt to try and pick up growth when the stock market is going up and when it's giving us those gains, but at the same time, it also attempts to mitigate the catastrophic downturns like we saw in 2008, which is when people were forced to go back into the workforce after retiring because they weren't allocated properly. So an actively risk-managed portfolio, again, tries to pick up gains when the market's doing well, but also tries to minimize the catastrophic downturns like we saw back in 2008. So that's something that you can kind of use to bridge the gap between being too conservative and too aggressive and kind of have the best of both worlds there. Okay.
And Tyler, people say then, okay, if you think that I'm too conservative or too risky, what should we look at? Well, first of all, let's look at what's your desired risk in retirement. Now, there are a number of things that come into play here. What is your actual tolerance? Regardless of your age, what is your risk tolerance? There are some people that absolutely wring their hands and feel nervous and look at their phone to see what their stocks or investments are doing on an hourly basis. Chances are, you're going to have an ulcer by the time you retire if that's the case. But you need to look at your own risk tolerance. Also, what's your time horizon too? When you go into retirement, you might have slated a certain part of your retirement income or your investments to pay off the mortgage over the next 3 years or so. That needs to be looked at too, and how much risk you take to pay off that fixed expense. And then, also, how much do you have? If you have accumulated enough money that is going to put you into retirement and you're not going to have to change your lifestyle as far as your income when you are working versus retirement, you don't have to take significant risk then. Why are we taking significant risk if you have accumulated enough that's going to pay out, give you the income you need, the liquidity you need in case there's emergencies over your lifetime? So we look at all those things. But Tyler, what else should we look at when somebody comes in and say, what is my desired risk? What should I look at for a diversified portfolio?
Yeah, no, that's depending on your risk tolerance, you're going to fall into one of a few categories, either conservative, moderate, or aggressive, or there's some between those, for example, moderately conservative or moderately aggressive. But for example, a conservative investor typically might have 20% stocks and 80% bonds, CDs, or annuities. So again, they're mainly investments that are low risk, but they still have a portion to stocks for growth potential. Moderate might have 60% stocks and 40% bonds, CDs, or annuities, and aggressive will be 100% or almost 100% stocks and stock funds. So that's kind of how it lines up in terms of conservative, moderate, or aggressive. And as you go on down the line from conservative to aggressive, you have more and more stocks and stock funds and less bonds and different fixed investments. Now, when we talk about that, many pre-retirees and retirees, so usually people that we see ages 50, 60, 70, they're going to fall into the moderate category. So they like to have a portion in stocks for growth potential, but yet they also need different bonds, CDs, annuities for stability and protection as well. So you want to have a good balance there. On the flip side, many younger people who are working, they're investing within their 401k, they might be in their 20s, 30s, 40s. Usually those people will fall into the moderately aggressive to even the aggressive category. And that's because they have that long-term time horizon on their side. They can afford to be more, they can afford to take on more risk because they have a longer time horizon. And then people who are retired, so maybe they're in their 70s, 80s, 90s, they might be moderately conservative to conservative. So again, as you go right on down the line, you're typically going to shift what your risk tolerance is over time and go from aggressive to more conservative as you age, get older, and get into retirement. But those are simply guidelines. We see it all the time where there's people who are 75 years old and they have a portion that would be considered aggressive, or people that are in their 20s and they have a portion that's considered conservative. So you can have multiple different portfolios, and many people do, where you can have three of them. One might be moderate, one might be conservative, and one might be aggressive. And you can manage each of them differently no matter your age. So keep that in mind. There's no one size fits all. But what we see is usually as you get older, you're going to shift more conservatively, and it's important that you either do that yourself or work with an advisor that can help you shift that over time.
Good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.